Welcome back and thank you for staying with eNCA. All eyes are on the Reserve Bank's Monetary Policy Committee announcement this afternoon. Some economists are warning of a steeper rate increase. Let's get the view of Investec's Treasury economist, Tertia Jacobs, just to tell us what she thinks about what we should expect today. Well, Tertia, obviously, it looks like the Reserve Bank has no choice but to to take it up this afternoon because things look bad across the world.
Hi, good afternoon. Yes, the outcome of inflation yesterday for October surprised a little bit on the upside, rising by 7.6% from 7.5%. And core inflation, so that would be the measurement for inflation that excludes food and fuel and energy, increased to 5%, which is the highest level since March 2017.
And for how long do you think we should accept the increase of CPI and repo rate? It looks like something that the Reserve Bank can't do anything about because their job is to make sure that everything is balanced, right? And they try to make sure that as consumers we don't die, but it looks like they have no choice because of what's happening across the globe. And so we're hearing from Reserve Bank Governor, for instance, Tertia Jacobs, saying that they might have to up, repo rates, etc., for quite a while before it stabilizes. What are you projecting? How much longer are we going to see an increase before it just at least reaches a point where it won't increase anymore?
That is such a good question. The key driver here will be, when is inflation coming down? And when will the inflation rate move below the current repo rate? For example, the repo rate, and the prime rate is 3.5 percentage points above the repo rate. It's currently at 6.25, with headline inflation at 7.6. So it's very conceivable that from March next year going into the second and then the third quarter, that inflation can decline quite substantially. The big driver there will be base effects. As we all know and felt, that the fuel price has escalated rapidly. So we've already seen the crude oil price coming down. It's now below $85 per barrel. And the rand now is trading below 17, right? So that's going to help to lead to quite substantial petrol price and diesel price cuts. From December for diesel and January, and then petrol still an increase in December, but quite a substantial cut in January. And that will start helping pulling inflation lower. And I think then, depending on where core inflation is going, it's not inconceivable that the repo rate can perhaps, this is now a forecast, that the rate hiking cycle could end in the first quarter of next year.
I really hope that what you're...
Because then inflation from the second quarter can fall below the policy rate, and that is a positive real rate. And I think then the Reserve Bank can take a step back and watch how the inflation dynamics are playing out.
Well, hopefully you're right, because, although the whole globe is going through this period and this difficult time economically, it's not easy for people living in a continent like ours, right? Those big economies such as your UK, US, etc., I think, are able to survive a bit more than us. But just lastly, Tertia, what is it that government can do to relieve the pressure, for instance, on consumers if this goes beyond the first quarter of next year, as you predict?
The government is in a very challenging position. We, at the moment, we still have some support from revenue receipts that have been doing relatively well, and that's mainly from the mining companies and some of the manufacturing and financial companies. But the problem now is with this intensification of load shedding, that growth next year is going to be lower than what we anticipated, right? So that can start to impact government revenue receipts. So there's going to be a lot of focus on government spending. We also know that they're taking over Eskom's debt. There is some kind of liquidity injection for Eskom because, Eskom can no longer afford to buy diesel because it's run out of it's spent more than its budget by now.
Yeah.
So it's going to be very difficult for government. So I think it comes back to, what can we do to try and fix load shedding, right? How quickly can we get some of the renewable energy programs back onto to start delivering new energy. How quickly can we start to fix Transnet? So it comes back to the structural issues that is providing bottlenecks, or that is creating bottlenecks and preventing this economy to grow at a somewhat faster pace.
Yeah, and for now, I mean, Tertia, yes, we do know that what's attributing to how badly economies around the world are performing is not necessarily self-inflicted in South Africa, because it's all started when the Russia-Ukraine, conflict began, oil prices also. But, what is it that we are contributing ourselves in South Africa that is also contributing to how badly, we're performing right now?
Look, the operational environment for companies are very challenging. With this increase in load shedding, companies, shopping malls have to acquire, generators, which
Yeah.
increases their input costs. As you rightly put out, there's an increase in input costs arising from the higher oil price. So I think the dynamic is, we'll companies and households will just have to tighten belts. Hopefully, in the second half, when inflation starts to come down, when some of the structural reforms begin to push through, we could see a bit of an improvement. But I think for I would say the next 4 to 6 months, we're in a very challenging spot.